dashboard there, and down towards the right, towards the bottom, there's a little button that says questions. If you click on that, a little screen will pop up, and you can type in your questions, and you can ask those questions really anytime throughout the course of the webinar. We'll be glad to answer them for you at the conclusion. I'm going to get started today. I'm going to give a short presentation just about the real estate market in general, some of the things that we do, some of the things that other people are doing in this space. And then I'm going to hand the controls to Brian, and Brian's going to clean up today for us and take you through his presentation and talk about Accuplan and all the things that you may consider to do with your 401k, self-directed IRA, or what have you. So going to be a lot of great information. We'll go through this as slowly as we can, but again, if you got questions, just stop us or just type them in at any time, and at the conclusion, we will take your questions. For those of you that are registered today through the Mike Harris radio show here in Los Angeles, these webinars are promoted on KFWB Talk Radio on Saturday mornings at 11 o'clock on the Mike Harris Real Estate Talk Show. It's a one-hour show on Saturdays here in Los Angeles at 11 o'clock. So for those of you that registered through Mike Harris' website, I want to welcome you on here today. If you don't know me, I'm Charlie Castro. I'm an independent acquisition specialist. I help people identify investment real estate in a variety of different markets. I work a lot with hedge funds, and we'll talk about that, which are institutional or corporations that buy real estate as an investment. I've done several hundred of these educational webinars over the last couple of years. Summit Assets Group is one of the large ones. REO Reseller, we did a lot with REO over the past couple of years. We did a couple in March with Robinhood Financial, seeing investing in real estate through the eyes of a financial planner. If you'd like to have a copy of that, I'd encourage you to do that. It was a very, very informative webinar with Ray Russo from Robinhood Financial. Today, of course, Accuplan. I've been a guest twice on Real Estate 360, which is a radio show up in San Francisco, carried on the Wall Street Journal Radio Network. Why would they interview a guy like me? Just because I have experience dealing with both the smaller individual investor like yourself, maybe looking to acquire one piece of property or two pieces of property through your 401k, but I also work with a lot of the institutional buyers, the hedge fund guys, and we'll talk about that. And so I have a little bit of a unique perspective because I see what they do to analyze a market and what they do to analyze what the best criteria is for them to buy a piece of investment real estate. So, and then, of course, a few weeks ago we had Mike Finn on with Meridian Pacific Properties. Had a great webinar with him, some great investment real estate down in Memphis, Tennessee. If you're interested in that market, I have that tape or that webinar on tape as well. So 2014, we're into May now. What do we know about the market? Early this year, we spent a lot of time talking about where the market's been, where we thought the market could be going in 2014. And the most common question I was being asked during that first part of the year from folks was this: did I get in too late? The market's rebounded. We know that the larger investors continue to buy, but is it too late to get in? And I don't think so. I think this is actually going to be the best year to buy investment real estate in 2014, and I'll kind of outline some reasons why I believe that to be the case. We do know that the hedge funds continue to buy. And if you don't know what a hedge fund is, by the way, and I love the cartoon because it kind of paints the picture, right? The hedge fund, they're specializing in highly complex derivatives and exotic financial instruments for that discriminating investor. And then the guy says, buy gold, which is like the simplest investment you can make, right? Buy a commodity. But it's really true. I mean, these hedge fund guys that are in this business, and if you don't know who these guys are, I'll give you some brief descriptions. There's the number of them. I'll highlight a few here. Blackstone Real Estate is the largest owner of single-family homes in the United States. They own 31,000 homes in 13 markets. John Paulson was the guy that accurately predicted the housing market was going to crash back in 2007, stood on the sidelines for a few years, and now is investing hundreds of millions of dollars in his own money. Warren Buffett, if you don't know, he was famously interviewed on MSNBC about 3 years ago now, 2 years ago, about 3 years ago now. And they asked him the question, is buying real estate a good investment? He went into all this description as to why buying real estate was a great investment. He went on to say that he would buy millions of single-family homes, but he wasn't very practical. He wasn't very handy. So what he was saying was that, yeah, I get it. Buying an investment property in another state makes great sense. There's great buys. Prices are at historic lows. But how do I take care of them? How do I manage those properties? How do I get them rented and have somebody collect the rents for me and fix the window when it gets broken? How do I do that? So what Warren Buffett did was, being Warren Buffett, in October of 2012, he purchased Prudential Real Estate. So if you didn't know, Warren Buffett is now heavily invested in the real estate market with Prudential Real Estate as his infrastructure, his feet on the ground in these markets that can take advantage not only of the best buys, but then managing the property on an ongoing basis. Two of my biggest clients is Property Direct and Havenbrook Homes. Property Direct's out of Utah. Havenbrook Homes is out of Atlanta, Georgia. These guys are aggressive hedge funds. I work with them daily, so I've got to learn as to what they do, how they think, where they buy, why they buy there. And people ask the question all the time, and my screen went dead for some reason. I don't know why I did that. Okay, apologize for that. But they're extremely aggressive buyers, and I've got to learn a little bit with regards to what they buy and why they buy and where they buy it, and there's a lot of reasons for it. I'll talk a little bit about. But the main thing is when you just kind of peel it all back, they just see real estate as the best investment in America today. They see it to be the safest place to put your money, to get the best rate of return, to earn the greatest amount of appreciation in the years to come. They see it as being the best place to invest. As I mentioned, Blackstone, they raised the largest opportunistic fund ever in the United States, $13.3 billion, 31,000 homes, as I mentioned, in 13 markets across the country. I already mentioned Warren Buffett. You can Google Warren Buffett, just say Warren Buffett on real estate, and you'll see all kinds of stuff from Warren Buffett. But the one common thing that you'll see from him, and I did a lot of research at the beginning of this year, sort of preparing as we went to 2014 for where the market may be headed. But the one thing he said most consistently was this. He just said, the housing market has improved, but it's far from recovered. These funds understand that there are markets out there where you can still take great advantage of buying at historically low prices with lots of room for appreciation. It's one of the things that Warren Buffett talks about all the time. It's just, hey, yeah, it's recovered, but there's still a whole ton of markets out there that still haven't recovered. There's a long way to go, which means there's lots of appreciation, lots of dollars to earn in these markets. And then John Paulson was recently quoted as saying, it's not too late to get involved. I think buying a home is the best investment you can make, and affordability is still at an all-time high. Some of the reasons that they buy, and these are the same reasons you may consider buying, whether it be through your 401k working with Brian, or whether it be through cash or a self-directed IRA. There's lots of good strategies that Brian's going to talk about. But these are some of the reasons why they buy, which are really the same reasons why you would consider buying. And one, of course, is just what I've been saying, is just you can buy at historically low prices. The second and third thing is just its income. The market's appreciating. If you buy in the right place, their markets are going up. You can get great cash-on-cash rates of return. I'll talk about what that looks like because the markets determine what sort of ROI you might get, and I'll talk about that. There's tax benefits. Now, I can't speak to tax benefits because I'm not a tax professional. I would benefits are, and there's lots of them. So as an individual looking to buy a piece of property, they should look closely at what those benefits are. Anything that you read statistically in America today will tell you that rents are going up. We're in a great rental market right now in America, and that the market is stable. One of the things the hedge fund guys will tell you is they'll say, we know that if we were in a paper investment that we're subjected to the market and the instability that exists in the market. We know in real estate that even a stumble like we saw in our economy in third quarter of 2013, we saw a little bit of a stumble when the government shut down and real estate was affected. It was affected pretty much across the country, but it was a blip, and it came right back up again. So the market is stable. It's not a market where you're going to get into it and get up one morning and go, holy cow, my investment just got wiped out by some event in the economy. So it's a stable market. Creative exits just means the ability to liquidate your asset when you want to. In any business that you invest in or anything that you invest in, one of the things you always want to look at is what's my exit strategy? How do I get out? Well, real estate, man, you can advertise on webinars like this one. You can put it on a for sale sign in the front yard and sell it on the MLS to an owner-occupant. You can go to any one of a dozen hedge fund guys and say, I got a piece of investment real estate. I want to get out. The reality of it is you've got all kinds of ways to exit and all kinds of options of which to sell that asset, whether it be in a month or whether it be in 10 years. Then lastly, of course, and Ray Russo from Robinhood Financial spent a lot of time, Ray's a financial planner, as I mentioned. He spent a lot of time in our last webinar talking about real estate's a commodity. It's not a paper asset. It's a real commodity. It's tangible. You can put your hands on it. And that means something to these larger investors and should mean something to you when you look at the different places that you might invest your money. So what's their strategy? There's two different types of strategy the larger investor looks like, and I'm just going to do this real briefly. The first strategy is what's their buying criteria. And what they do is they will send you an email about every 3 to 4 months, and they'll say, we're now in this market. We're going to be, for example, we're moving into Charlotte, North Carolina in about 30 days. So this is our market. We want at least a 3-bedroom, 1-bath. It's got to have at least a 10% cap rate or rate of return on your investment, on their cash investment. It's got to be built in a certain period of time. In other words, nothing 1940 or older, something like that. So they have a buying criteria. They know exactly what they want to buy before they buy it. Now, I would say to any of you as a smaller individual looking to buy that you want to have your buying criteria too. I think that's a smart strategy. Understand what you're trying to accomplish before you go into it. The second part of their strategy is what do they do with it after they buy it. So they've purchased it. They understand the market. They've studied it. They've done research. They know that's a good market. They're in that market. They know what they're looking to buy. They acquire it. Now what do? I can tell you that with the exception of only one large corporate buyer, there's only one that flips. All the other ones buy and hold. They see this as a buy and hold market. They see it that if you're going to buy something today, if you don't hold it for at least 12 months to take advantage of the tax benefits, the cash flow income, letting the market continue to appreciate before you sell it, at least 1 year. But these guys are in it for the long term. So the quote I borrowed for this slide is from Jonathan Gray. Jonathan Gray is CEO of Blackstone, the largest owner of single-family homes in America. So this is what he says. He says he believes the housing market will remain bullish for 2 to 4 more years. I believe that to be true. I think it's market dependent. I think some markets are already dead. They're already maxed out. Markets have probably 4 or 5 years left in them. So I believe it's market dependent. The second thing is, he goes on to say, is their strategy is to isolate key markets for growth, renovate the properties, and then lease them out. So one thing that's important about that I'll draw your attention to, and I put it in red here, it's important. When he says isolate key markets for growth, he's not talking about the number of houses he can get. He's talking about markets that have room to appreciate, markets that are still way below the previous peak. Those are the markets they look for. So if you follow where the hedge fund guys you know for some certainty, because they put a lot of time and research into it, that those markets are going to be the markets that are going to appreciate. They're going to continue to climb. You're going to have the best chance of not only getting a cash-on-cash return, but also getting appreciation on the home on a year-to-year basis. And then finally, he says the houses are 94% occupied, and we're trying to build a long-term business here. Rental market is solid, and a long-term business is what they're in this for. So they're in this for the long haul, not the short term. Now, that doesn't mean you can't get a good flip. You can get good flips. I pulled this off U.S. News & World Report about 6 weeks ago. This is not 8 hours ago, about 6 weeks ago. But I love the article, and if anyone wants a copy of it, I can get it to you. It's a really good cautionary tale for those looking to do flips. I'll just do it real quick. If you're going to do a flip, there's 2 places you can make your biggest mistakes. If you don't estimate what the rehab costs are up front, you could lose money. And this on the other side, kind of bookended, if you don't estimate what you can sell it for, you can lose money. So the common mistake is you buy a house for $50,000, you estimate $25,000 in rehab, and you think you can sell it for $125,000. But the reality of it is you bought it at $50,000, it really cost you $50,000 more to rehab it, and you can only sell it for $110,000. So your financial model goes upside down. So I love the quote they had in this. It said, if location, location, location is the mantra for all real estate, then do the math, do the math, do the math is the mantra for would-be flippers. So if you're going to flip, make sure you know your numbers, because that's where people make their biggest mistakes. Just some stuff off the news wires real quick. This is from Bloomberg, February of this past year. Just saying about 77% of investors with at least $1 million in assets own real estate. And it's the #1 alternative investment for 2014, with 1/3 of millionaires surveyed saying they plan to buy this year. Now, most of us aren't millionaires. All that simply says is people with lots of that's had lots of success recognize real estate as being the best place to invest their money. Again, Bloomberg saying wealthy investors are turning to real estate as fixed income yields remain historically low and equities surge, basically buying low, selling high, makes good sense. And then finally from credit.com, just to give you an example of where the market is, and I talked about it early on in my presentation, is this a good time to buy? Well, in 2013, 44% of all sales that were made in the United States were cash transactions. There was no loan recorded at the time of closing. What does that say? Just basically says people are buying real estate as an investment. They're not going out and getting a loan. They're paying cash for it because they see its advantages in terms of investing. And then finally, Prudential Real Estate, again, Warren Buffett's company. This is just a consumer outlook survey they had. They indicated the consumer's perception of residential real estate is increasingly favorable, and the consumers are more committed to buying and selling in 2014 than any time in the past. And I'm going to give you guys some really good reasons why I believe that to be true in a few slides, but I believe that's absolutely true. I think this is the best time, really, even though we're 6 years now beyond the meltdown, 5 years beyond the meltdown, clearly there's lots of reasons why this is the best time. So these are some things you want to look for when you consider real estate in your investment portfolio. So how do you compete? I just got them telling you what the hedge fund guys are doing. It may come as a surprise to you, but the individual investor now can get access to the very same type of inventory that those guys that are buying 100 houses a month do. Number one, you got to buy below market value. If you buy anything from MLS, everything that isn't off market, you're not going to get the best deal. You got to buy something off market. The second thing is you got to buy direct from the selling party. You can't have people in the middle. I know there's lots of companies out there that do that. I would advise you not to do that. You don't want to be paying companies to buy real estate, for them to mark it up, for them to sell it to you. You want to buy it direct from the selling party, and I'm going to show you in a few minutes how you can do that. So buy below market value and buy directly from the selling party. That's where your best deals are going to be found. Don't buy anything that's not off market. I already said that. Look for both ROI and appreciation. Now, I say that because some markets, and I'll use Atlanta as an example. Atlanta traditionally was an awesome market for appreciation, and the cap rates were 10, 11, 12%. Because of competition there now, your cap rates there, you just can't find as many good deals, so your cap rates or your rate of return, year-to-year rate of return is 6, 7%. So what I say to folks is, look, you can get both. I understand you might be infatuated with Atlanta, but if you can get great deals in Toledo, Ohio, or in Birmingham, Alabama, or Memphis, Tennessee, or Nashville, or Charlotte, North Carolina, you want to go where the best deals are, where you get both ROI and appreciation. Your infrastructure is critically important, and we can talk about that offline because I could do a whole webinar on just how you work with property management teams, and there's some great ones out there. This whole mortgage meltdown thing that occurred in 2008 has created an industry of very professional property managers that manage people's investments. Understand your long and short-term strategy. As I said a few minutes ago, your buying criteria is just as important as the big guys. Understand what you want to do. If you're in it for a flip, know going in that you want to do a flip. If you're in it for the long haul, understand how long that might be. Not that you can't change your mind. Lots of folks go in on a long-term strategy and 6 months later say, I want to sell it because I can make profit on it and go buy that over there. That's nothing wrong with that. And only buy fully rehabbed and rent-ready homes. And I say that because I have had some experience with some groups that sold homes that weren't completely finished yet. Don't do that. From experience, if you're going to buy investment real estate, when it closes, it must be done, completely finished, rehabbed. Now, the way you do that is you buy directly from wholesalers. Now, I want to paint a picture of what a wholesaler is real quick. A wholesaler is somebody that works in a specific market that knows the market better than anybody else. They're typically either a realtor or a construction worker or maybe an appraiser. But there's someone that knows the market. They know the schools. They know the crime rates. They know the best areas for resale. They know the best areas for home ownership. The wholesaler is the guy you want to deal with. The wholesaler is the guy that's been selling to these hedge funds and these larger buyers for the last 5, 6 years. You now can get direct access to them, and I'll show you how you can do that in a minute. I love this article by Ken Corsini. I use a lot of his blogs. He's talking about how this can be a great benefit to you to buy directly from a wholesaler. What's interesting is this is from 2011. 2011, you never would have gotten access to a wholesaler, which is one of the reasons why I think this is the best time, because you as an individual investor can go directly to the people that are owning and rehabbing the properties, buy directly from them, and cutting out everybody in the middle. Now, how do you do that? Basically, we just launched a website. It's just a consumer's marketplace, a wholesaler's marketplace, if you will, incomepropertyhq.com. These are some of the markets that we currently have inventory available in, and I can give you lots of details about that if we talk. But these are the markets that the hedge fund guys are in. So these are the markets where we've got wholesalers, and these are the markets where you can get direct access to those wholesalers and get inventory at the same prices that those larger buyers buy at. I'm going to give you a comparison here real quickly. Why out of state? Because a lot of people say to me, Charlie, you're in California. Why are you not buying in California? And I say to them, but the answer is really simple. If you just look at the comparison of what you're going to buy for in California versus what you buy out of state, you just look at the analogy. In San Jose, California, median price home is $605,000. That's a $605,000 home. In Birmingham, it's $60,000. You see the year built, bed and bath, very similar, square foot, very similar. But look at the rent. In San Jose, $24.95 against a $600,000 investment. In Birmingham, that $60,000 house, which I'm going to show you in a minute, renting for $960,000. So look at the rent ratio comparisons, and then look at the cash-on-cash rates of return. This is the reason why the cash buyers, the larger institutional buyers, are buying outside of places like California. There's some in Texas, but not many. Certainly not in New York. They buy in the smaller markets. That's their best rate of return. people think that it needs to be in their own backyard. It really doesn't. Professional property management is available in lots of places. You're going to get a higher performance level from a property management company as opposed if you were to do it again or do it yourself rather. And this is the reason why, again, Havenbrook, for example, which is based in Atlanta, Georgia, buys all over the country. They buy very little in Atlanta, Georgia. They simply know that their management teams can manage it better than they can. So it's not like they have to be there to be able to manage the property. And they're going to save you more money than they're going to charge in fees. Typically, it's a 10% fee to have your property management. Well, 10% fee, they're going to save you money versus if you were doing it yourself or somebody was doing it for you inefficiently. And there's less hassle. Letting somebody else manage your property for you basically makes it a turnkey investment. You go online, you look at your report, you can see when your next rent check's coming in, what it's going to be for. You can follow the performance on your property online. You don't have to be there. You can go online and see it. So what you want to look for is you want to look for people that operate in a region that have excellent investment characteristics. You don't want to buy C neighborhoods. You want to always buy at least in a B neighborhood, if not an A neighborhood. You want to make sure the operator you're working with is turnkey so that you've got a turnkey product. There's no more rehab to be done. There's none of that involved. It's all done either ready to be rented or already rented, and that the property management's already in place. Quality renovations is absolutely important. I'm going to show you a few pictures of some renovations here in a minute. You get sort of an idea what we're looking at. And they got to have at least 5 years experience. If somebody's been doing this for 6 months, you don't want to buy from them. I mean, you want to make sure they've got a nice reference list too. I ask all the wholesalers I work with, they all have to provide a reference list. And there's got to be transparency in numbers. What does that mean? Ask for an inspection in every case. You want to have the property inspected, know exactly what you're buying by an independent inspector. And you want to also be able to make sure that it's a typical closing process through a reliable, large law firm that does these types of closings. So there's transparency in numbers. You can see exactly what you got the house for, what the closing fees are. It's all transparent to you. You want to look for quality neighborhoods with good tenants, stable returns. You want to make sure that the property is being taken care of. You want to be able to ensure that your maintenance has been reduced as much as you possibly can. These are all things we help you do, by the way. Lower vacancy and evictions mean stronger returns, so your property management team is really critically important. The neighborhoods mean everything, and we always give out a neighborhood report. It's really important that you understand what the neighborhood report's all about. I'm only going to spotlight one of those cities, and that's Birmingham. I'm going to show you how a hedge fund determines where they want to be. This is just one city, for example. So Birmingham, CNN Money says it's the 10th best overall real estate market in the country. That's actually wrong. It's now the 8th best. I'll show you that slide in a second. They all say it's the 3rd fastest growing real estate market, and New Wire says of the top 10 cash flow markets in the United States, Birmingham is number 3. Now this is another reason. This is the stuff they look at. In 2014, of the top 10 hottest housing markets for 2014, Birmingham is number 8. And you can see why they'd go to a market like this, because the forecast between now and September of 2014 is 8% appreciation. So if you're getting 10, 12, 14% cash on cash and 8% appreciation, you can see the type of investment that you're looking at. And this gives you some examples, and I'm going to turn it over to Brian. This is from a wholesaler. $47,000 with $750 rent. Zestimate says it's worth 62, and ePraisal says 52. And you got a potential cash on cash, or not potential, your projected cash on cash rate of return is about 13%. So you're buying under market value with an excellent cash flow in a market that CNN Money says is going to appreciate almost 8% by September. And then another one, 3D Properties. And you get an idea, look at the rehab to the right. Now, if you saw the photo gallery on this whole house is essentially brand new. The guts inside this house is essentially new. It's not just carpet and paint. This house is rebuilt. So you get an idea here. This is the picture that I had on the slide that compared the San Jose house. So $60,000 got a $960 rent. So you're looking at a cap of almost 16%. And ePraisal says it's worth almost $80,000. And then just one more. I just got this morning from same company, from 3D Properties. You can look at the quality of the workmanship here. It's going to rent for $1,000, selling for $65,000 at the cap of 15%. It was sold last year for $88,000. Now that's a house you could literally hold for 1 year and flip it, and make 10 grand easy, not including what you make month to month, cash on cash rate of return. But that gives you some ideas of why those markets are so appealing to the larger buyers, because you can get such just awesome deals in those markets. So with that, I'm going to turn it over to Brian. I want to thank everyone for being on today. I want to remind everybody that we are going to take questions at the end of today's webinar. So if, again, look to your right of your screen, you will see a dashboard there. And in there's a little button that says questions. If you just click on that, you can ask your questions in that box, and then we'll take those at the end of the webinar. So with that, Brian, do you have the controls?
Not yet. I don't know. Waiting for
Okay.
it.
How about that?
I think it's coming now.
How's that?
Here we go. Show my screen. All right. Thanks very much, Charlie. It's always good to hear what's going on. You always have a lot of latest and greatest info. I'm very excited today to be on. Thanks for taking the time out of your day. Again, as Charlie said, my name is Brian Davis with Accuplan. I'm a business development manager for Accuplan in San Diego. Before I get too deep, a little legal disclaimer. Accuplan, we're third-party administrators. We're not financial advisors. We don't endorse any products, so please do your own due diligence and when looking towards investments. And I'll talk a little bit about what it is that we do, so not to confuse everybody. But going back to myself, again, Brian Davis. My parents are rice farmers up in Northern California, so you could say I've been in real estate my whole life dealing with that. I graduated college at UC Santa Barbara in 2001 and moved down to San Diego shortly afterwards. From there, I got into real estate right away. I was doing loans. I was in a builder division of doing subprime loans for one of the major banks, and in the middle of 2007, subprime went and builder kind of went right back to back. So that kind of left me in a lurch of, what was my next move? So I continued in financial services, got my life insurance license, did life insurance and annuities, was looking into the retirement planning side when I realized I kind of wanted to get back into real estate, and I kind of fell into an opportunity in 2009 to do self-directed IRAs. So I've been doing this for just about 5 years. I've opened up about 1,000 IRAs and solo 401ks, and I've been with Accuplan the last 2 years. And Accuplan is a third-party administration wing of, we also have our own trust company called American Estate and Trust, which allows us to be an IRA custodian. So it's 2 separate companies. I represent Accuplan, but all the clients, they use American Estate and Trust as custodian. And we allow people, we do the administration for IRAs and solo 401ks to allow people to invest in everything allowable under IRS guidelines. So what many people don't know or haven't known in the past, everybody's starting to catch on now. With the rise of the information age, when it comes out when people like Mitt Romney, when he was running for president a few years back, has a $100 million self-directed IRA, the word is getting out that people aren't limited to investing in stocks, bonds, mutual funds, ETFs, and annuities with their retirement funds. So what we've seen in the past, people have about $5 trillion in their IRAs. This doesn't even include the other 11 or 12 trillion that's in like 401k type plans and pension plans. But like I said before, the majority of that has been in those traditional investments because most of the custodians are those brokerage companies. They specialize in the securities, those stocks, bonds, mutual funds, and they have a nice platform. It's very easy for them to make money and do all the recording. Everything's publicly traded. It's not messy as opposed to a hard asset with some of the record keeping can be a bit more tenuous, which is what we specialize in. We really focus on those alternative asset space. And by alternative assets, I really just mean non-publicly traded assets. What we are seeing mainly are these 4 asset classes. Real estate being number 1 by far. Notes. Private companies. Private companies is big. It can be a lot of real estate funds it's just a private fund. And then a lot of these crowdfunding companies that are coming out. You also probably have seen maybe the commercials on invested metals with your IRA. That's something we do as well. I just typically don't see that client with my background being real estate. And I'm in Southern California. I'm mostly seeing real estate investors. But there's just about anything your IRA can invest in. So just as this list states, you can list in trust deeds, raw land, lease options, promissory notes, private placements. The list could go on and on and on. The IRS never made a list of what's an acceptable investment, really only what's not acceptable. And they listed only 2 things. And this comes from the ERISA Act in 1974, which Congress laid out, which kind of started the IRAs that we have today. And it listed you had to have a custodian that will hold these investments. And that's exactly what we do. But they said you can't invest in life insurance contracts or collectibles through your IRA. And this list right here is some examples of what the IRS deems a collectible: work of art, rug collection, alcoholic beverage, anything illegal. And even in the mid-'80s, they even came back and they allowed some certain types of precious metals. You'll also hear, if you listen to other things about IRAs, that S-corps. IRAs can't invest in S-corps as a member. That's an S-corp rule, not an IRA rule. But what you do want to focus on, besides those investments that the IRA is not allowed to invest in, is what's called a prohibited transaction. Now, I'll try to keep this as low on the jargon end as possible, but please feel free to ask a question on this. So, prohibited transaction is when an IRA gets involved with a disqualified person. And the basis of this is there's no self-dealing in your IRA. And if you want to look this up online, you can look up IRC 4975. That stands for Internal Revenue Code 4975, which is the tax law in regards to self-directed IRAs and 401ks. Basically, it says that you're a disqualified person in your IRA. You can't have any personal benefit. And besides yourself, as other disqualified persons would be your spouse, your parents, grandparents, children and their spouses, grandchildren and their spouses. So you want to kind of think about it in a straight line up and down. Side to side can kind of be okay, but that straight line up and down, the IRS can say, you know what, they're getting a personal benefit from it. Those are who we're going to consider disqualified. And besides those people, companies in which they're basically the majority owner of. And there's a lot more detail in 4975, and if people have questions, please feel free to ask me about this. And the reason why I bring this up, it's very important, because if the IRS, who they're essentially the police on this, were to audit you and look at all your IRA transactions and see a prohibited transaction in there, they'll go back and disqualify that IRA from January 1st of the year that transaction occurred, which could have some huge tax implications for you, because that money at that point will be considered a distribution to you, and there could be huge tax consequences, and especially moving forward. So to try to bring this point home, I won't harp on it any longer than this, play a little game here. I'm sure everybody remembers the game Deal or No Deal from NBC a few years back. So let's do this in respect to your IRA. Can your IRA lend yourself $10,000? Deal or no deal? That one's no deal. That's self-dealing right there. You're getting a personal benefit from the IRA. What about your brother? Can your IRA lend your brother $10,000? Deal or no deal? On the face of that, that's fine. That's a deal, as long as you're not trying to skirt around the rules. If the IRS says, hey, you loaned him $10,000 from your IRA and he went and just loaned it back to you, they'll go ahead and bust you for that. So there's really not a way to skirt around the rules, but on its face, lending to your brother is fine. What about your stepson? $10,000. This one is deal on its face. So if it was your son, this would be a no deal for sure. But if it's your stepson, the IRS has said, oh, that lack of blood relation there, I guess, wouldn't be as big a deal to them. And last but not least, what about your daughter-in-law? That one is no deal. Your children and their spouses. So I know it gets confusing, and that's why people like me are here to help guide you through this process when you're using a self-directed IRA, but you do want to be a little bit careful. The next part I want to cover here is, how do you put money in a self-directed IRA? I would say, all right, I think I get it. How do I put money in a self-directed IRA? Well, self-directed is really just a marketing term that our industry uses because we allow people to direct the investments themselves. We don't have investments for them to invest in. They direct the investments in anything that's allowable under these IRS guidelines. So we have traditional IRAs, Roth IRAs, SEP IRAs. So if you have like an existing IRA, we do what's called a trustee-to-trustee transfer, where we move the cash from your existing IRA over to an IRA with us to allow you to invest in everything allowable under IRS guidelines. There's no tax consequences here. The other option is if you have funds in a qualified plan like a 401k. You want to do what's called a direct rollover and direct your old 401k administrator, 401k, to do a direct rollover to the IRA you open with us. Question I get here a lot, well, what about my current job's retirement plan? Can those funds be moved over to an IRA? The answer to that is maybe. Some plans allow what's called an in-service rollover, which means while you're still in the plan that you can roll over a portion of your IRA, but not all plans allow that. So you need to ask your plan administrator if you're thinking of using those plans to invest in IRA investments. And finally, you can make an annual contribution to an IRA. Most people that have a W-2 job, they fall in lines of being able to have a traditional or Roth IRA. Excuse me, a traditional IRA is a pre-tax IRA. So when you put money in, you're able to write off the contribution, and the funds grow tax deferred. When you pull those funds out at retirement age, you'll be taxed on them at that time as earned income. A Roth IRA is different. When you make the contribution to the plan, you are not being able to write that off your taxes, and it grows tax-free. So when you pull those funds out at retirement, you're not going to pay taxes on them at that point. A SEP IRA is another one I want to point out here. This is a self-employed pension. It's for a self-employed individual and their employees, and it works very much like a traditional IRA in that it's pre-tax. So if you're self-employed, you can have this type of plan. You can contribute up to 25% of your adjusted gross income with a cap at $52,000. Now, whatever percentage you give yourself, if you have employees, you would have to make this contribution for them. The other plan I want to point out, because a simple plan is a very little used plan. It's similar to a 401k plan, but for smaller companies, and the contribution limits are much smaller. The other plan I want to hear is individual K. You also hear it called a solo 401k. Essentially, it's a 401k plan. And a 401k plan for a self-employed individual with no employees, there's a lot less regulations on this plan. So if you fit that mold, that box, where you're self-employed and don't have any W-2 employees, you can have your own 401k plan. It doesn't matter if you're incorporated or you're just a sole proprietor, but you can make contributions as both employee and employer. And the caps are a little bit higher here, as you see, and I'll talk a little bit more about it. So we call ours the 1K. So the product works is we have a 401k plan document. You as a self-employed individual are the plan trustee. You're the plan administrator. So essentially you have the power of your whole 401k in your hands. You can go open up a checking account at your local bank and have full checkbook control of your 401k dollars and invest directly into investments from that 401k plan. We have the plan document. We help you get the tax ID number for it and help walk you through setting up the bank account. A lot of people still set up a separate company, but most of my investors that have this product, they do it directly through the 401k plan. So it doesn't matter if you've incorporated or not. This graphic kind of shows that you are. So you create the 401k plan. You can roll over any other pre-tax retirement dollars in it, and then start making those contributions and invest directly yourself without having to go through the custodian every time. So again, you can purchase real estate. The 401k rules are a little bit different. For folks that have had a 401k at work, you can actually loan yourself money as a plan participant. That's a little bit different than an investment loan to yourself. But if anybody has any questions on this, please let me know. So similar to the checkbook options that the 401k provides, you can also get a checkbook IRA by creating an entity that your IRA owns. A lot of people have done these and have used the LLC method, and we can help set that up for you. The IRA becomes the sole member of the LLC. You become an unpaid manager. So that gets it around those rules of disqualified persons by you being a manager of that LLC. The problem here, especially in California, is you're going to have to pay $800 a year plus a gross receipts tax, which could add up if you're fixing and flipping property. So a business trust has been another popular model that I subscribe to, especially for investors that are based here in California. Works very similarly to the LLC method. The IRA becomes the beneficiary owner of this business trust, and the IRA owner becomes an unpaid trustee. The difference here, the IRA doesn't have to worry about paying the California Franchise Tax Board fees. So it's a great tool, and if anybody has more questions on it, I have a separate website devoted to that called retirementcheckbook.com. So for most of those folks that are just opening up an IRA and going directly through the IRA process, you can open up the IRA online with us in a matter of minutes. It's on my website. Then we work on funding the account. That's generally the longest part of the process. It takes about anywhere from a few days to a few weeks to get those IRA dollars over from either your 401k plan or your IRA. So keep that in mind if you have an investment. You want to start working on moving that money over if you're eyeing towards this type of investment. And then on funding the investment, we generally take about 1 to 2 business days. And then we hold the asset in your account. Again, you're not limited to investing in the stock market. You can invest in real estate, which Charlie was gracious enough to show us some great examples and some great markets to look at for out-of-state investing for those of us here in California. But that's all I have today. Charlie?
I am here, Brian. Thanks so much. And I would tell everybody, too, Brian, every time I listen to one of your presentations, I learn something new. And I talk to a lot of people that are looking to do something by using an existing 401k or IRA or setting one up. And I really encourage you guys to give Brian a call. Brian, you're always gracious to talk to the people that attend these webinars, and I would really encourage you to make that phone call and learn all that you can. These are really important things to do when you consider what you're doing, whether it be for your retirement portfolio or just your investment portfolio. So I'd really encourage you to do that. So Brian, again, thanks for being here today. I'm going to take questions now. I'm pulling up my question screening here. I got nothing in the queue yet. If we don't say anything, I want to thank everyone for being on here today. I did record it, as I think I mentioned. So it is available for those of you that are on here today. For those that registered and couldn't attend, I will be sending it out to all of them as well. Okay, question. Could you go over the conversion process from a 401(b) to a Roth IRA? 402, I'm sorry, guys, a little bit of blurred vision here. From a 403(b) to a Roth IRA.
Yeah, 403(b) is something very similar to a 401k plan. So if somebody has one of these qualified plans through their work, they would roll over to an IRA. And actually, you could roll over directly to a Roth IRA. For our accounting purposes, we just kind of we open up a free traditional IRA and then just charge for the Roth IRA. And then what you do is called a Roth conversion there. So whatever dollar amount you have that you want to convert to is, let me back up. Those 403(b) dollars are most likely pre-tax dollars, meaning when you put the funds into the 403(b), those came out of your paycheck pre-tax, and the company matched it on a pre-tax basis as well. So that would move to a traditional IRA without any tax consequences. Whatever dollar amounts you convert to a Roth will count as earned income for the year you converted. And you don't have to convert all of the dollars, but whatever dollar amount you do convert to a Roth, that would count as earned income for you for this year. So if you did it this year for 2014, then you would have, that much dollar amount counting as earned income for you that year. But then from there, it would grow tax-free. And again, I just want to reiterate, you don't have to convert it all at one time. If you want to do it in pieces, you should probably talk to your financial advisors, CPAs, about that.
Brian, that's all the questions I have except for one about financing. I can answer that one just real quickly. And the question specifically was, what kind of financing is available when buying something through your 401k or self-directed IRA? I don't know of any financing. Brian, do you?
I do. There are some non-recourse lenders who will lend to your IRA. North American Savings Bank is the largest one in the country. And I have clients use them all the time. And then different regional banks sometimes will do it. I know here in SoCal, I know a list of some folks that will loan, but they're generally just looking in that area. But North American Savings Bank, they pretty much go all the way across the country. And I'm sure there's another one or two. I don't get paid by any of these companies. I just know that North American Savings Bank is the largest one. And,
okay,
and they generally want...
So we're going to leave Brian's contact information up here. Contact Brian for more details, because I don't know. I've worked with a couple of non-recourse lenders, and I didn't have the best experience. And not because they did anything wrong or anything like that, but just simply because the fees for the ones that I was able to find, were like really, what's the word for it? It just prevented from doing. I mean, if you're buying a $60,000 rental, for example, and they're going to charge you 10% for a paper fee. I can't remember what they called it, an initiation fee or something. You're paying $6,000 up front for that. You're essentially giving away your first year's income to just acquire the loan. I mean, you're really better to go partner up with a relative or somebody before doing that.
Right, and another thing that comes into play, there's something called unrelated debt financed income. So if you are using debt financing through your IRA, there's a tax associated to your IRA for the percentage of financing you get. Now the 401k is exempt from it if you're doing the solo 401k, but if you're doing that through an IRA, this extra tax comes up that you have to calculate as well. So keep that in mind. It is a possibility, and if anybody has more specific questions on that, my contact information is on the screen here.
Okay, that was the last question I saw in the queue. I want to thank everyone for being on today, Brian. I especially want to thank you for being here, as always. We'll do one of these again next month sometime.
Yeah, I want to thank you guys as well. I appreciate having me on today.
And again, if you got questions, I always keep my phone line open for at least 2 hours after these webinars. So if you have any questions, feel free to give me or Brian a call. So I want to thank everyone for being on here with us today. Hope to talk to you soon. And Brian, thanks again. We'll hope to talk to you soon.
Thank you.